Why does a letter written by a man in his 90s become a must-read Bible for global investors? Warren Buffett, the legendary Oracle of Omaha, shares his wealth-building secrets and life insights through Berkshire Hathaway's letters to shareholders with the warmth of a neighborly elder. From Coca-Cola to Apple, from economic crises to market frenzies, these letters chronicle Berkshire Hathaway's journey from a failing textile mill to a trillion-dollar empire while revealing how to navigate wealth with wisdom in an uncertain world. Let's dive into this investment classic to uncover how Buffett uses simple principles to achieve extraordinary returns and guide our lives. Letters to Shareholders began in 1965 and has continued for nearly 6 decades, with each annual letter brimming with deep reflections on investing, business, and human nature. These letters are more than Berkshire's annual reports. They're a treasure trove of value investing, rational decision-making, and long-term thinking. Whether you're a market novice or a seasoned professional, this book prompts you to rethink the essence of wealth. It doesn't chase short-term profits but guides you to find your path in complex markets with a calm mind and steadfast belief. Buffett once said, "Investing is simple, but not easy." This idea runs through the book, reminding us that success lies in sticking to principles and understanding human nature. The book's appeal lies in its universal and accessible nature. Buffett uses humorous metaphors, real-world examples, and plain language to break down complex investment concepts into everyday wisdom. He likens a company's competitive edge to a moat, explains brand value through Coca-Cola's global popularity, and shares his journey from selling chewing gum as a kid to managing billions in assets. The letters offer macro insights, like his accurate predictions on inflation and interest rates, and micro-analyses, such as his takes on Geico and Apple. More importantly, Buffett blends investing with life lessons, exploring how trust, patience, and ethics shape success. This is not just an investment guide but a philosophical book on how to think and live. Let's explore Buffett's investment philosophy, stock picking methods, market insights, corporate governance, risk management, life wisdom, and timeless lessons. This journey will reveal the profound insights of this remarkable man and inspire your own path in investing and life. Chapter 1: The Roots of Wisdom from Graham to Munger. Buffett's investment philosophy wasn't born in a vacuum. It's built on the wisdom of mentors like Benjamin Graham, Philip Fisher, and Charlie Munger, forming a unique value investing system. Graham, the father of value investing, taught Buffett to buy a stock as if you're buying the company. In The Intelligent Investor, Graham's margin of safety principle, buying stocks below their intrinsic value to reduce risk, shaped Buffett's early approach. In 1950, at age 20, Buffett bought Geico shares at $21 each when their book value far exceeded the price. He wrote in his 1980 letter, "Graham taught me that investing isn't gambling but analyzing a company's long-term value." This investment yielded Berkshire decades of multiplied returns, laying the foundation for his wealth. Graham's approach helped Buffett stay rational amid market swings, focusing on intrinsic value over short-term prices. However, Graham's focus on low prices overlooked company quality, a gap filled by Philip Fisher's common stocks and uncommon profits. Fisher emphasized investing in high-quality companies with growth potential, urging deep research into management, industry prospects, and competitive advantages. Buffett applied this in 1963 by investing in American Express during its salad oil scandal when its stock plummeted. Through fieldwork, like visiting restaurants to confirm consumers still trusted Amex cards, he saw its core business was intact and bought in. As he recalled in his 1991 letter, "Fisher taught me to focus on a company's long-term potential, not just its balance sheet." This move netted Berkshire multiple-fold profits, showing that quality companies can deliver big returns despite short-term setbacks. Charlie Munger, Buffett's longtime partner, shifted him from cigar butt investing to buying great companies. In 1972, Berkshire paid $25 million for See's candies, well above its book value. Buffett wrote in his 1983 letter, "Munger taught me to pay a premium for a great business rather than a bargain for a mediocre one." See's, with its brand loyalty and pricing power, generated billions in profits for Berkshire, proving Munger's wisdom. Munger also introduced multidisciplinary thinking, urging Buffett to analyze businesses through psychology, economics, and more, making his decisions more holistic. The blend of Graham's rationality, Fisher's focus on quality, and Munger's emphasis on premium businesses shaped Buffett's philosophy, evident in every letter. This evolution turned Berkshire from a struggling textile mill into a trillion-dollar empire. Chapter 2: The Core of Value Investing: Circle of Competence, Moat, and Long-Term Thinking. Buffett's letters highlight three pillars of successful investing: circle of competence, economic moat, and long-termism. These simple yet profound principles, distilled from decades of experience, form the soul of value investing. The circle of competence is Buffett's starting point. You don't need to know everything, but you must know what you don't know. It means focusing on areas you understand and avoiding unfamiliar temptations. In 1996, amid the tech stock boom with soaring Microsoft and Intel shares, Buffett stayed out. As he wrote in his 1998 letter, "I only invest in businesses I understand, even if they seem less trendy." Tech's rapid changes were beyond his grasp, but he mastered consumer goods and insurance. This focus helped him dodge the 2000 dot-com crash while capitalizing on opportunities like Coca-Cola and American Express. The circle of competence isn't just an investment rule. It's a life lesson. Excelling in what you know best doubles your effectiveness. An economic moat is Buffett's key criterion for evaluating companies, likening them to castles protected by barriers against competitors. Moats can be brands, cost advantages, or network effects. In 1988, Buffett invested $1 billion in Coca-Cola, a third of Berkshire's assets, writing in 1989, "Coca-Cola's brand is an unmatched moat, chosen by a billion people daily. Its loyalty ensures pricing power, even as costs rise, yielding Berkshire hundreds of billions in returns." Long-termism is the soul of Buffett's philosophy. Investing isn't a short-term game but a journey of growing with great companies. During the 2008 financial crisis, when markets panicked, Berkshire invested in Goldman Sachs and General Electric. Buffett wrote in 2008, "Be greedy when others are fearful, as long as you believe in the company's long-term value." This strategy reaped massive profits post-crisis. He often says, "Our favorite holding period is forever." In 1973, he bought the Washington Post for $10 million, holding it for decades to earn multiples in returns. As he noted in 2007, "Time is the friend of great companies and the enemy of mediocre ones." These principles, sticking to what you know, choosing moat-protected companies, and thinking long-term, form the bedrock of value investing and offer a guide for navigating life's complexities. Chapter 3: Stock Picking Wisdom: Seeking the For Goods. Buffett's letters outline his for goods criteria for picking stocks: good business, good management, good returns, and good price. These guide his major investments at Berkshire, balancing business fundamentals with financial returns. A good business is simple, stable, and competitively advantaged. Buffett favors clear, enduring industries like consumer goods and insurance, writing in 1987, "A good business is like a wide moat, standing the test of time." Geico, with its direct sales model cutting costs and attracting loyal customers, became a Berkshire cornerstone after Buffett began investing in 1976 and fully acquired it for $2.3 billion in 1996. Good management is the soul of a company. Buffett values rational, honest, and independent leaders, writing in 1993, "We don't need genius managers, but they must be trustworthy." His 1988 Coca-Cola investment was bolstered by CEO Roberto Goizueta's global expansion and brand focus, making it a global beverage leader. Good returns mean high profitability and capital efficiency. Buffett's $1 rule demands that every dollar of retained earnings creates at least $1 of market value. See's Candies, with its brand-driven high margins, exemplified this in his 1983 letter. In contrast, he avoids low-return sectors like airlines, joking in 2007, "If someone invents a time machine, send me back to 1986 to stop myself from buying airline stocks." A good price is the lifeblood of value investing, buying great companies at reasonable or undervalued prices. In 2016, Buffett began buying Apple at about $100 per share, far below its intrinsic value, writing in 2017, "Apple's ecosystem and brand loyalty convince me it's worth more." By 2025, this investment generated over $100 billion for Berkshire. The four goods create a clear framework, simplifying markets and offering investors a replicable path to success. Chapter 4. Market Insights: Seeing Through Bubbles and Crises. Buffett's letters are a masterclass in understanding market cycles, using sharp observation and historical perspective to navigate bubbles, crises, and opportunities. His bubble spotting relies on rationality and common sense. During the 2000 dot-com bubble, tech valuations soared amid new economy hype, but Buffett stayed out, warning in 1999, "Valuations lose rationality when markets get euphoric." Citing the 17th century Dutch tulip mania, he foresaw the 2000 Nasdaq crash that wiped out many tech firms, while Berkshire remained unscathed. As he wrote in 2000, "Markets are a voting machine in the short term, driven by emotions, but a weighing machine in the long term, reflecting true value." Crises are where Buffett's contrarian thinking shines. In 2008, during the subprime crisis, he wrote in the New York Times, "Buy American." He invested $5 billion in Goldman Sachs preferred stock with 10% dividends and warrants, and $3 billion in General Electric on similar terms, noting in 2009, "Crises test a company's moat and offer the best time to buy great businesses." These deals earned Berkshire billions by 2011. His macro insights are equally sharp, analyzing inflation's impact in 1986. Only companies with pricing power, like Coca-Cola and Gillette, can withstand rising costs. His 1989 $600 million Gillette investment leveraged its global dominance for steady cash flow. He also warned in 2017, low interest rates inflate asset prices, but they're a double-edged sword, a prediction validated by the 2022 market turbulence from Fed rate hikes. At its core, Buffett understands markets are driven by fear and greed, writing in 2001, "Fear and greed are ever present, but you can choose not to be controlled by them." This clarity helps investors stay grounded in turbulent times. Chapter 5. Corporate Governance: From Textile Mill to Empire. Buffett's letters reveal how he transformed Berkshire from a failing textile mill into a diversified empire through governance principles like decentralization, incentives, and long-term vision. In 1965, he bought Berkshire's controlling stake at $14 per share, but the textile business was unprofitable. He admitted in 1970, "Textiles were our mistake, but they taught me to reallocate capital." Redirecting cash to insurance and consumer goods laid Berkshire's diversified foundation. As he wrote in 1985, "Good managers don't save dying industries. They invest in high-return areas. Decentralization is key. We hire smart people and let them do their thing," he wrote in 1996. Subsidiaries like Geico operate autonomously, with Buffett focusing on capital allocation, enabling Geico's CEO Tony Nicely to grow it into America's second-largest auto insurer. Incentives align managers with long-term goals, tied to profits rather than stock prices, as noted in 2005. Nebraska Furniture Mart's Blumkin family, for example, earned rich rewards while delivering steady profits. Buffett's long-term vision avoids short-term gains for lasting value. As he wrote in 1988, acquisitions like Nebraska Furniture Mart in 1983 and General Ray in 1998 fueled steady growth, while his 2010 BYD investment, banking on its battery potential, yielded multiples in returns. Berkshire's partnership culture aligns managers and shareholders, creating a lasting empire. Chapter 6. Risk Management: Finding Certainty in Uncertainty. Buffett's success stems not just from seizing opportunities but from masterful risk management, seeking certainty in an uncertain world. He balances concentrated bets with strategic diversification, writing in 1993, "If you have 40 wives, you won't truly know any of them." Berkshire's core holdings Coca-Cola, American Express, Apple comprise over 80% of its portfolio, but its insurance businesses, like Geico and General Ray, diversify risk across sectors. As he noted in 2002, "Insurance is our safety net. Avoiding leverage is non-negotiable." He called it financial poison in 2009, citing the 1998 collapse of long-term capital management due to high leverage. Berkshire's $300 billion cash reserve in 2025 ensures flexibility in crises. Deep research mitigates risk, like his months-long study of IBM services before investing in 2011. As he wrote in 2012, "If you don't understand a company, you're gambling." He turns volatility into opportunity, securing favorable terms into 0080's Goldman Sachs and General Electric deals with preferred stock and warrants, writing in 2010, "Risk comes from ignorance, not markets." This approach offers a life lesson: focus, caution, and knowledge create stability in uncertainty. Chapter 7: Life Wisdom, Trust, Patience, and Ethics. Buffett's letters transcend investing, offering a philosophy of life centered on trust, patience, and ethics. Trust is the foundation of his relationships with shareholders and partners. As he wrote in 1991, "We want shareholders to see Berkshire as their own business, and we treat them like family." Transparency, admitting mistakes like 1990 Seconds Airline Investments or 2001 General Ray Ayres, earns loyalty, with Berkshire shareholders holding stock for over 20 years on average. In 1991, he saved Salomon Brothers during a bond scandal by transparent reforms, winning trust from regulators and investors. Patience is his cornerstone. "Investing is like planting a tree out today, shade tomorrow," he wrote in 2004, recalling his $114 stock purchase at age 11, held through volatility for profit. His 1988 Coca-Cola investment, never sold, reaped decades of gains. As he noted in 2015, "Time rewards the patient in investing and life. Ethics are non-negotiable. Losing money is fine. Losing reputation is a disaster," he wrote in 1990. He prioritizes character in partners, donated $4 billion to the Gates Foundation in 2006, and avoided dishonest firms like Enron, writing in 2002, "Integrity is the best moat." These principles, trust, patience, ethics, offer a timeless guide for building wealth and living meaningfully. Epilogue: An eternal dialogue on wealth and life. Berkshire Hathaway's letters to shareholders is a half-century conversation, distilling complex investing into simple truths. Buy great companies at good prices and hold forever. This isn't just a strategy, but a way of life. Buffett's philosophy teaches that success comes from understanding essentials, not chasing trends. From long-term gains, not short-term wins. From surpassing yourself, not others. From buying his first stock at 11 to writing letters in his 90s, his persistence embodies long-termism. In 2020, he wrote, "Never underestimate America's potential or your own." This inspires investors, entrepreneurs, and everyday people to act within their competence, seek moated opportunities, and face challenges with patience and ethics. The book's value lies not just in teaching how to make money, but how to think. It reminds us that wealth is a tool, not the goal. Wisdom is the lighthouse guiding us through uncertainty. May you find your own answers in Buffett's letters, walking steadier and farther in your journey of investing and life.